Now that you have a thorough understanding of the basics of finance in the U.S., Steve will now dig deeper into an equally important subject that you, the listener, need to understand for your financial planning. Please join Steve now in understanding core economic concepts.
Few areas of finance lend themselves to jokes as readily as do economics and economists. These prognosticators extraordinaire do their very best to tell us what will be based on what is and what has been. But predicting the future has never been easy. And while history does repeat itself, it never repeats perfectly, so that lessons once learned may only partly apply to lessons to be learned. In many ways, you and I are at the mercy of these individuals, and sometimes more than you might think. It is the government's economists who set everything from interest rates to the cost of living increases in Social Security, all the way to the amount of taxes you pay. These individuals have opinions that range all over the place on issues like, is inflation good or bad? But in order to develop a financial wealth plan for ourselves, we have to understand at least some basics about economics, how it works, how it's measured, and then apply this knowledge to the next steps in preparing a financial plan. In order to walk through this body of knowledge with some semblance of sanity, I'm going to base this session on the 10 laws of economics that I wrote about for the Steve Beeman Group. We'll go into each one in detail. What are the 10 laws of economics? Law number 1, supply and demand are at the core of every ultimate price. Number 2, fear and greed run rampant in human psychology and always will. Number 3, the herd mentality is very real and it is very hard to oppose. Number 4, government laws don't eliminate number 2, they just move it around. And number 5, in general, people work for material compensation, not for altruistic goals. Number 6, left alone, people will solve most of their material problems, and need drives supply, which then drives demand. Number 7, economic freedom without a shared moral value system is corruptible. Number 8, government must exist to create basic rules for economic activity and establish basic laws, but cannot be a successful and arbitrary redistributive agent. Number 9, people must be responsible for their own circumstances, notwithstanding those who cannot look out for themselves. And finally, number 10, caveat emptor, or buyer beware, is good advice, and knowledge is a necessary tool to prevent individuals from having their material compensation redistributed without their knowledge to someone else. Now, many of these laws are irrefutable, but there are a couple where debate rages on as to the validity of the notion. So if you're ready, here we go. Law number 1, supply and demand are at the core of every ultimate price. This is an irrefutable truth and ultimately plays out in either free or state-controlled markets. There are books written about this, but to be quite honest, I have a problem making it more complex than it is. Supply and demand is a very simple fundamental law, period. The more there is of something, the less financial value it has. Now, anyone reading this will say, well, what about Beanie Babies? There was an ample supply, but the prices kept going up. To them, I will say, and then what happened? Ultimately, supply and demand worked out. Think about it this way. If I have 2 books and 10 interested buyers, what happens to the price that the buyers set? Now, on the other hand, if I have 10 books and 2 buyers, what happens then? It's that simple. And yes, this law does scale up. You and I hear horror stories about the $200 toilet seats purchased by the U.S. military. Well, the reason for this is that you have a fixed demand. The military wants a bunch of these very customized toilet seats, and you have a limited supply. You might ask, well, limited supply, I can buy a toilet seat anywhere. Well, this is where distortion to supply and demand comes in. The reason the supply is so limited on toilet seats, for example, is that the bureaucrats who build the specification for the military acquisition of toilet seats makes that specification so tight that not only is there a limited number of manufacturers, but so frequently there have to be customized tooling done, customized production processes, and all of the customized work to accommodate the specifications. So the demand is there, but there's tight supply. It's slightly more complicated, of course, but the law holds true. So as you build a financial plan for yourself, realize that prices set for your labor, your house, for your investments, and for everything else are predicated on the supply and demand for that specific thing. The reason pay goes up as degrees go up is that there are less MBAs from Harvard than there are undergrads. It's a tighter club. Now, in that example, there is one interesting distortion. According to the Bureau of Labor Statistics, MBAs, that is, people with graduate degrees, earn more compensation than do people with doctoral degrees. This would seem to be a distortion of the supply-demand law. There are more MBAs than there are PhDs, so should not the PhDs earn more money? I would suggest that this does not reflect a distortion of the law of supply and demand, but simply reflects the financial value of people's choices and value propositions. Many PhDs elect to work in academia, which pays less than private sector jobs. Therefore, the law of supply and demand isn't refuted. It's simply that there are additional dimensions which include value propositions of individuals. If only two people elect to create a job, for example, that plays banjo on rainy days in Chicago, should they make more than the tens of thousands of people in downtown Chicago going into their offices to work? No. Just because there's a limited supply does not always mean there's a healthy demand. Law number 2, fear and greed run rampant in human psychology and always will. Recent research into the cellular structure of people has indicated that even at the cellular level, we are hardwired for a fight versus flight response. This very distinct two-sided coin drives much of our behavior, whether we know it or not. Likewise, the basic instincts of fear and greed run just as deep and affect us whether we're conscious of them or not. Abraham Maslow, in his seminal work on the hierarchy of needs, outlines that our first objective is to secure physical safety. And then we move up to emotional safety and up from there. The point is that our first fundamental drive is to work and eliminate fear from our existence. We strive to find security. In the area of economics, studies have shown time and time again that we fear loss more than we reward gain. This would be consistent with Maslow and suggests that our stronger instinct here is fear. Fear leads us not to take risks, to try to stay with the status quo, and to live by the old adage, the devil you know is often better than the one you don't. Fear drives so much of our behavior that as you build your financial destiny, you must come to grips with it and balance your fear with the other major driver, greed. We all remember Gordon Gekko's famous quote from the movie Wall Street, "Greed is good." Well, to some point, this character right out of that movie demonizing Wall Street was right. The issue is how we define greed. The definition of greed is, and I'm quoting, the excessive drive to secure wealth. And this is listed, by the way, in traditional Christian literature as one of the 7 deadly sins. But in the context of building your financial future, think of greed as your desire to have more and better things, lifestyle, health, and all the rest. The reason this is important is that it's the greed side of the equation that oftentimes causes us to engage in economic transactions that otherwise might seem stupid. Why do people play the lottery? Well, some people play it for fun. Okay, that's fine. But others play it out of an almost irrational desire to use it as a vehicle to gain wealth. They say, well, someone's got to win. And so they rationalize their $2 or $3 purchase every week at the local lottery window. But here's a fact. The odds of winning are so small that a mathematical calculation would prove that odds of winning range from 1 in 14 million to 1 in over 175 million for the mega lottos. Think about it. In order to guarantee a win from a state mega bucks lotto, you'd have to buy 175 million tickets at $1 each. The only way to win is not to play, to steal a phrase from Joshua, the doomsday machine in the movie War Games. But the irrational desire to better our position leads us to make decisions like this, and then we can be called greedy. But other more obvious signs of greed play out. Look at the recent housing bubble. How many millions of Americans sought to purchase more home than they could afford simply because someone was willing to loan them money? This is greed gone nuts. Believing that A, prices would always rise, and B, their negative amortization loans would never come due, millions of Americans invested not on the fear that prices would fall, but on the greed that prices would rise. Like fear, in order to build a sensible financial destiny, you must gain control of the greed factor in your life. Greed and fear are obviously emotions. If you study the best investors, you'll find that they do not use emotions in their decisions. No, quite the contrary. They have taken complete control of their fear of loss and their greed of gain, and they operate purely on an analytical level of those probabilities. That is why the vast majority of people who go to Las Vegas lose. I mean, look at those beautiful casinos you've paid for. But some people do win. Certain games are statistically winnable if you have a keen mind and have complete control of the fear and greed components of your personality. Law number 3, the herd mentality is real and it's very hard to oppose. As part of our basic need for security, most people tend to find safety in the crowd. This is what builds financial bubbles. When something is popular, it's hard for many people to ignore it. And likewise, when something's not popular, it's difficult for many to desire it. In investing, there's an old adage about buying straw hats in winter. What that's referring to is the need to be somewhat contrarian in your financial dealings. It's quite hard and most can't do it. But often, in fact, most of the time, you have to train yourself to move away from the crowd, fear, to make smarter choices. When everyone else is jumping on the bandwagon, it may feel safe to play to your greed. I want some of that too. But oftentimes you're setting yourself up to simply participate in a bubble. The savviest investors recognize this and frequently will move opposite of the crowd, even though it seems somewhat riskier. Number 4, government laws don't eliminate number 2, that is fear and greed. They just move them around. Okay, here's one that is perhaps debatable by some, but not because it isn't true, but only because people don't want it to be true. Fear and greed are universal. The only thing that is impacted by governments, large or small, is how fear and greed play out. If we try, for example, to eliminate greed through social engineering, we find that the only way to do this is to increase fear through implementation of a punitive system. If, though, we employ too punitive a system, economies will collapse because the fear drive is so strong that it won't be worth the risk to move up the scale to greed and hope for a better life. But, and I'm sure of this, no amount of social engineering will eliminate the greed factor from people. In any society, any system, some person or group of persons has more than others. In the communist state that was the Soviet Union, a state that ostensibly eliminated greed by making it all but impossible to gain wealth, there was still a wealthy class. The politicians lived lives that were the envy of most of the world. Their greed for power and money was extremely evident. I would therefore propose that we not try to eliminate something so fundamental to the people as fear and greed, but that rather we try to work with these concepts to improve the economy at large. Greed, for example, does not always have to refer to money. Greed can include recognition, accolades, and all the like, and I believe we can effectively exploit the supposed greed of the financially wealthy by trading some portion of their financial wealth for other things, including recognition and the more universally beneficial objectives. Number 5, in general, people work for material compensation and not for altruistic goals. Okay, so not everyone works for money. That's a partial truth. I find it interesting that people who say that, they themselves usually live a pretty darn good lifestyle. So yes, after you've accumulated a reasonable amount of lifestyle, it's pretty easy to say, I don't work for the money. But a little self-honesty is called for. Yes, there are people in our society who do their jobs out of love. I get that. In fact, it could be said that I've never worked for money because I've always loved what I've done. Okay, that's true. But without a certain level of compensation for it, I doubt I ever would have done it. So let's look at an example of a job that has traditionally been thought to be at the low end of the financial compensation ladder: teachers. Now, since I've been a kid, I've heard teachers talk about how they do it for the kids and how they don't do it for the money. Okay, I have a question then. Why is it that teachers so regularly strike and now have pay packages that put them well above the average mark in compensation? I'm not being critical. I'm just looking for honesty. It's human nature to want more. More life, more food, more clothing, more housing, more everything. You know, there's an old saying, much wants more, and it's true. It's not a bad thing, so let's quit hiding from it. Okay, so I want to be paid more. So what? Why is that bad? If we look at our economy in general, we find that whenever tax cuts are employed, look at Kennedy or Reagan, for example, the economy grows. Why is that? It's simple. When there's more money in a given activity, more people will engage in it, period. Ask yourself honestly, do you work for the money? I'm willing to bet that at least 90% of you would raise your hand and say yes if you're being honest. Well, that's not bad. Don't be ashamed of it. The value of our labor and our ideas are measured by the amount society is willing to pay us for it. And in a free market, that's a wonderful thing. The more you're worth, the more you're paid. Yes, that's too bad for some, but it's great for others, so welcome to life. Law number 6, left alone, people will solve their most material problems, and need drives supply, which then drives demand. Now, this is a notion that's up for debate. Does supply drive demand, or does demand drive supply? You know, the old notion, if you build it, they will come, or will you build it if they come? I tend to believe it's a little of both, but the first part of my statement holds true. Left alone, people will solve most material problems. If you need a shirt, someone will make one for you, but you'll have to give them something of value in return. On the other side, someone has a new idea for a gadget that will make your life easier. They will build it on the speculation that you will buy it. Now, this is where it gets interesting as a debate. It's almost a which came first, the chicken or the egg. There is a huge debate going on today between the people who believe demand drives the economy and those who believe supply drives the economy. Well, just as in the simple example above, both do. It is ultimately the demand for a better lifestyle from everyone that drives people to be open to transferring their wealth voluntarily to another. But it is the supply of new and innovative ideas that drives people to be willing to do that. So both are right. The issue here is debated due to the nature of government involvement. The economists fight back and forth. Which is more stimulating to the economy, government spending or tax cuts? Should we tax individuals or tax businesses? I will suggest this, and here again, as I try to do this, I'm going to try not to get political. But the best way to stimulate an economy, I believe, is to give people a larger share of what they themselves earn. Thus, rather than a $700 billion government spending initiative, I believe it would be more stimulative to have provided, for example, a $700 billion tax cut. This way, people directly would have more money to both generate demand and create more supply. Law number 7, economic freedom without a shared moral value system is corruptible. At the core of a successful free economic model is the idea that moral values are shared. We see around the world circumstances in which economies operate without a shared moral compass, and without exception, they devolve into a crime-ridden system of fraud, deceit, blackmail, and bribery. In order to sustain a free economy, the participants must share certain moral beliefs. Among these are honesty, integrity, honor. You remember, my word is my bond. Without these, the free economy will increasingly move into a regulated economy, which will then begin to slow it down. Look at the example of Bernie Madoff. Due to his lack of a moral compass and its overarching influence on so many, we find ourselves now receiving more and more regulations to regulate the behavior of all people, most of whom would have operated honestly anyway. The examples are all over the place of where the few dishonest, unscrupulous people abuse our economic freedoms and thus make it more difficult for all of us to have a positive journey on our financial path. Law number 8. Government must exist to create basic rules for economic activity and establish basic laws, but government cannot be a successful and arbitrary redistributive agent. Now get ready for the debate. I do not believe that a society left without any government can survive. Basic laws of fair play must be put in place in order to assure order in that society. For example, it is to me at least obvious that laws against stealing, fraud, and contract violations, not to mention other things, must be in place. However, as I believe the laws of economics supersede government and are more natural laws, government itself can only attempt to create rules that apply to everyone, so those rules are understood and predictable. Clearly, there's a debate here as to what level, and we'll leave that to another time. But the second part of this question is the debate. We are now engaged in an open debate in the United States about the notion of redistribution of wealth. I believe it is a natural law that government cannot effectively do this. Now, to prove that, let me simply draw out what happens if we follow this to a natural conclusion. If we choose to redistribute the earned income of those at the top to those at the bottom, which we presently do to a huge degree, for example, the top 10% of Americans pay 90% of the income taxes. Now, by the way, I'm not saying whether that's good or bad. I'm simply saying it's a fact. But here's the problem. To the extent that we redistribute more from the top to the bottom, we will get more people who elect freely not to produce. After all, why should they? If we're paying people not to work, they won't. As this group of non-producers then grows, the burden on the producers will grow larger. And thus, more of them will elect to join the non-producers, which in turn will put more pressure on the producers. You can see the cycle here. If we follow this out, eventually no one is producing anything because they're not paid to. Now understand, I'm not saying that all local, state, and federal programs to help the poor are bad. They're not. But we must recognize that they are dangerous in that the unintended consequence is often the ultimate problem. We must carefully balance the needs of those who cannot provide for themselves against the redistribution of those who can. What we do not want to do is to create a situation in which there's an overriding incentive not to produce. And okay, this is likely going to get me in trouble, but I would suggest to you that all this talk about forcing a living wage, and yes, I include the minimum wage in this, well, that doesn't ultimately do anything to eliminate poverty. It simply causes inflation. Look, when I started out back in the 70s, I earned an hourly wage of $2.65 an hour. Well, today the minimum wage is 3 times that, $7.50 an hour. But are the people who earn $7.50 any better off? No. Prices simply have risen to accommodate the new wage. Now, it's well beyond the scope of this session to debate the merits of social policy, but I think it's important for you to have some basic understanding of the issues as you seek to build a better financial future. Law number 9. People must be responsible for their own circumstances, notwithstanding those who cannot look out for themselves. In her famous book, It Takes a Village, Hillary Clinton outlined her belief that the successful outcome of a family takes a village or a community to work. I'm not going to agree or dispute that, but I would add to the idea of a community that the only way communities work is if we have people who are accepting of their own responsibilities. No society can prosper when people offload their responsibilities to the society at large. Again, logically, what happens if everyone does this? People, as individuals, must take responsibility for their own lives in all things. Clearly, there are those who cannot take care of themselves. And for those people, I believe we do have a responsibility to care for them. And by the way, I believe we should care for them much better than they're presently cared for. But the other side is also true. For those who can function as individuals, incentives must be in place and disincentives removed so that they take responsibility for themselves. All the good intentions in the world will fail to lift people out of destitution if those people do not individually take responsibility for getting themselves out of that destitution. And finally, law number 10, caveat emptor, Latin for buyer beware. That's good advice, and knowledge is a necessary tool to prevent individuals from having their material compensation wrongly redistributed to someone else. We can and should look to laws to enforce fraud statutes and the like, but that does not take away from us as individuals the need to be smart, informed, and aware so that the unscrupulous operators among us, and there will always be those, so those people cannot redistribute our income and wealth to them without our knowing it. How do we identify the next Bernie Madoff? How do we identify the next snake oil salesman that comes along promising the world but at the core offers nothing? I believe we do this through increasing our knowledge on all levels and through having a somewhat cynical eye that sees through the motives of those purveying ideas and products.
I don't know about you, but I never took an economics course in school. And these 10 laws of economics that Steve provides are a great way to further your knowledge as you continue to learn about core economic concepts. Now let's explore the notion of expectations. How do you value an asset? Have your expectations become greater than they should be realistically? Listen as Steve gets into a more advanced area of finance, but crucial for your financial life.
Years ago, a very good friend of mine called and said, "Steve, I have a problem. I'd like to take my wife on vacation, but it's going to cost $10,000 and I've only got $3,000. Do you have any ideas on how to work it out so I have the money I need?" I asked how long he had, and he told me he had 3 months. Well, my immediate comeback was, sure, go to Las Vegas. The bottom line of accruing returns is that they directly relate to risk. Sure, if you're willing to bet the whole thing and lose it, you can earn sizable returns, but the probabilities are small that you'll win. On the other side, you can fully secure your principal and not risk it at all, if there is such a thing, but you'll only be paid a minimal return on your money. The expectations game is at the core of setting up a financial plan. So often, investors are misled into believing they can achieve unreasonable returns without taking commensurate risk. So what should you expect from your investments? What is a reasonable forecast of returns so that you're neither too optimistic nor too pessimistic? Well, friends, the only way to gauge reasonable expectations of the future is to look backwards and attempt to extrapolate returns from the past. This isn't a perfect science by any stretch of the imagination, but it's the best we can do. And barring any substantive changes to the system, I think we'll be pretty close. When it comes to investment returns, there's a great deal of history, thankfully. After all, the New York Stock Exchange was founded under the buttonwood tree in either 1792 or 1817, whichever date you want to ascribe to its beginning. Either way, that's a fair amount of history to determine returns from one asset class, stocks. With bonds or debt, well, that data goes way back as well. So the bottom line is that we can have adequate history from which to make estimates of a reasonable future. Further, we have knowledge of major economic cycles which help us to temper our forward forecast to hopefully better reflect our reality. Simple statistics show that since 1928, a relatively good period for the United States economically, stocks on average have returned 9.26% per year. Now, the first thing you need to understand is that this is an average. It does not mean that you'll get 9.26% every year, each year. Nor does it mean that over short periods, let's say 10 years, that you'll get that return. For example, from the year 2000 to 2009, the return from stocks was actually a negative 0.96%. This is really, really important to understand. Returns from any asset class are very dependent on the time frame that you're measuring. From 1960 to 2009, a period of significant economic growth, stocks returned more than the average they historically had. So what can we take away from this? First, if you're a stock investor and you meet the market returns, your long-term average is going to be around 9%. Now think about this. That's not a bad return since inflation during the same time has run around 4%. So you're not only preserving capital, but you're actually gaining real economic growth by around 5% per year. That's not bad at all, and keep that in mind as you consider your estimated returns from any investment. By the way, if we extend back the data to as far back as 1871, we find that the returns stay around the same. In fact, stocks have returned on average around 8.7% per year from 1871 up through 2009. Okay, with this simple fact of stock returns, let's switch gears for a moment and look at the history and how it may or may not be replicated in the forward period. I have good data going back to around 1871 on stocks, okay? And as I stated above, from 1871 to 2009, stocks returned around 8.7% a year, with some periods of up and down clearly. Well, okay, what can we say about the period, though? We can say that during that era, the United States grew from being an isolated nation following the Civil War to the global superpower following World War II. And subsequent to World War II, we were the single biggest, fastest growing economy ever experienced on this planet. We can further state that we grew from a relatively unregulated economy to a widely regulated economy, from a nation with no central bank to a nation with a powerful central bank, from a nation with no social safety nets to a nation with numerous safety nets, and from a nation with no income tax to a nation with a wide variety of income and capital gains taxes. Keep in mind, I'm not making value judgments on whether these changes have been good or bad. I'm simply laying a foundation to help make a prediction of the future returns that we can expect from various asset classes. Several key changes have taken place which may cause us to rethink whether that historical return is an accurate forecast. I want to cover this thought and then retrace back to the historical number and see if we can still live with it. The most major change that has happened over the recent past could cause there to be substantive changes in return expectations, and that's technology. The explosion in communications technology on all levels has now created a world that is much more interdependent than ever before and much more fluid. Goods now manufactured in nations around the world can be transported cheaply and efficiently to anywhere else in the world. This has created a new competitive landscape and is serving to bring the third world countries into the second world. But it's also serving to cause new levels of social unrest in the first world. Now, I'd like to draw this out a little bit and take it to the next level. If technology has allowed us to communicate and interact globally on a much more massive scale, and in turn, that's caused manufacturing to move to the lowest cost provider, at least as measured by labor cost, what's the next step? Well, I believe the next step is the repatriation of manufacturing to locations nearest the point of consumption. But you may say, what about higher labor cost? And to this I say, labor, what labor? Robotics will become the productive tool used to build product in the future, not human labor. In fact, you know how you and I look back on previous times with the thought in our head of how could they have thought that? Well, I can assure you, 200 years from now, they're going to look at us and say, what? People produced goods in those factories? The reality is, with the growth in artificial intelligence and overall computer technology, robotics are now truly coming of age. In 1982, I wrote a booklet called Computers Made Simple. And in that book, I wrote about the year 2000. I wrote about how we would wake up, go to our home office, check the latest stock prices, etc. Well, here we are in 2010, and I'm saying that increasingly through the next 20 years, manufacturing jobs will be relocated to their point of need, and robotics will produce the goods that are now produced by people. This isn't rocket science, it's writing on the wall. So what does that sea change in manufacturing have to do with returns from asset classes? Well, the dislocation of people that will be caused by this resetting of manufacturing could lead to a change in the return from stocks, for example. Will corporate earnings rise or will they come down? Will they rise as costs come down or will earnings fall as demand reduces? Furthermore, will the demand king switch from being the United States to China? I personally believe this is inevitable just because of the sheer size of the Chinese population. In fact, as I wrote this in June of 2010, it was just announced that General Motors, the nation's largest car company, now sells more cars in China than in the United States. And China just superseded Japan as the world's number 2 economy. This isn't a surprise, but it's a true chance of dislocation for the United States and other developed countries. So what I'm saying in a nutshell is that I believe it is naive of us to think just because we have a 100-year period of returns from stocks, bonds, bills, etc., we shouldn't be too quick to assume the next 100 years will look like that at all. In fact, if you study the data, you'll find that the period of the 1800s was frequently in a period of falling prices, where the 1900s have largely been a period of rising prices. So in a nutshell, I say be careful when you estimate future returns based on the past. It's pretty simple, right? But with that said, here is some underlying justification for the returns you can expect moving forward. The goal of any investment is twofold. A, to protect capital from loss, and B, to increase the value of that capital. Okay, so in investing, there's something called the risk-free rate. This is the return you should expect to get even though you've taken little or no risk with your principal. This amount has historically been measured by the 90-day United States Treasury bill. The thought being, if the United States defaults on these bills, you have a lot more to worry about than money. And as Treasury bills are very short term, you bear no inflation risk to speak of, unless that is we encounter hyperinflation a la Germany in the 1920s. But barring those two incredibly unusual outcomes, the return you receive from U.S. Treasury bills is considered to be risk-free. In today's market, you're receiving about 17 basis points or 0.17% per year. Not very much. In fact, it's almost zero. So for putting your money at no risk, you effectively make no return. Now, there is something also called a risk premium that you should be aware of. This is the premium that you get for taking additional risk. Now, risk can be defined as either directly losing your money, that is, your investment goes down in value, or you can lose money in real terms even if your principal stays the same. Well, how is this, you might ask? How could you lose money in a treasury bill if the government pays you back every 3 months? And the answer is inflation. Recorded inflation today is running at an annual rate of about 2.5% a year. Thus, if you invest your money in the risk-free 90-day treasuries for less than 1% per year, your money is devaluing at that 2.5% inflation rate each year. So you're actually losing money on this risk-free investment. So as you begin to think to yourself, I need to make more money than that, you have to prepare yourself as well to take more risk. It's that simple. There is no free lunch. I don't care what someone tells you in a fancy seminar that you've attended. There is simply no way to increase returns without some commensurate increase in risk. Okay, now here we go again with Wall Street parlance. To you and me, risk is losing money. If I give you $100,000 as a loan and you don't pay me back, that was risk. If I invest $10,000 in your new business and it goes up, then down, then up, then down, but at the end I get $20,000 back, that wasn't a risk at all, right? So risk has acquired different meanings. To the Wall Street crowd, risk is largely defined by something called mean variance standard deviation. In English, that's how volatile something is. To Wall Street, if you can generate a perfectly stable return, even if it's really low, say 3% a year, but it's stable, that's good. The reason is that Wall Street can leverage those returns due to their stability. You and I can't do that, but Wall Street can. So to you and me, risk is losing money. To Wall Street, risk is volatility. And I'll throw in a third just for fun. To me, risk is the future we don't know. If I know I'll lose money, I have no risk. So kind of to sum that up, there are 3 measures of risk: losing money, volatility, and ignorance. Okay, so let's go back to seeing if we can't build legitimate expectations for returns. If the risk-free rate is less than 1% and the inflation rate is 2.5%, there really are a couple of factors you should be aware of when trying to guesstimate future returns. Time horizon and asset class are just two of these. Time horizon matters because if you're going to tie up your capital for a long period, now long can be defined by your personal situation, but if you do that, you'd better make sure you've secured enough return to cover the inflation risk of your money. Okay, let's assume for a minute that you're going to loan some money. This could be to the federal government, through a bond, to a state government, a big bank, a company, even a small company or a friend. When you make this loan, you're going to look at the safety of it, right? How likely are you to be paid back? You're also going to look at the length of time of the loan. If one of these loans is long-term, and let's say that's more than 5 years, you have to add a level of risk to that. Why? Well, inflation. In 1975, had you bought a 10-year bond, you would have lost out on the ability to invest your money in the early 1980s at unprecedented high levels of return. If you buy a 10-year bond today, that is, you loan some entity money for 10 years. How do you know what inflation will do? My bet is we're going to experience a historically high level of inflation due to recent Federal Reserve policies. If I'm right, your 3% yield on a treasury bond isn't going to look so attractive, is it? Now, if you can afford to live on that 3% yield, perhaps locking it in isn't a bad move. If preservation of capital is your only concern, that may be fine. But if you're looking to grow capital, you need more return. Okay, we've been through this. So to generate more return, you can increase the time you tie up your money. As we showed, the 10-year bond earns 3% versus the 90-day treasury bill at less than 1%. So time has value. The other form of risk is based on asset classes you select. Each asset class has valuations and return expectations based on the past, the present, and based on its relationship to that risk-free return. Think of this as a sliding scale. We start with 90-day treasury bills and slide up to 1 or 2 year treasury bills. Now, at some point in here, large banks will begin to be competitive. For example, a 1-year certificate of deposit from a bank might pay the same interest as an 18-month treasury note. You're trading here time. Now, for some, a small risk of principal. As we move up the scale, we start to see general corporate bonds come into play. These are more risky than government bonds or bank CDs, so they carry a higher risk premium and yield. A 10-year government bond returns 3%. Similar term, that is 10-year CDs, pay 3.5%. A similar corporate bond, again a 10-year bond, might pay close to 4%. So going forward, you can estimate a floor of around 3% or so on longer-term bonds. But an upside, well, that's kind of scary. We have virtually no inflation today, which is keeping these bond yields down. However, even though the economy may or may not recover, we can still have inflation. Look to the 1970s and the stagflation that brought about. Well, after that rout, bond yields shot up to around 15%. And if we get there again, all I can say this time is lock them in. Now, as we move from bonds to stocks, there are several components to understanding and estimating returns. First, U.S. company stocks during the period we mentioned earlier from 1871 to 2009 returned around 8%. Think about it this way. Stocks, in return for the increased volatility and chance of losing money, return 5% more than risk-free vehicles. Now, many of us have grown up in a period, especially during the 1990s, when stocks seemed like the place to be. The average return for stocks during the 1990s was over 18% a year. Now, keep in mind the long-term historical average is around 8%. So clearly, the 1990s were on the very high end of the return spectrum, and quite possibly for many of us, a once-in-a-lifetime run. Now let's look at one metric that can put an estimated return on stocks. As of July 2010, the average price-earnings ratio on the S&P 500 was a little over 18. Now think about this price-earnings ratio. This takes the earnings of a company and divides it into the price. That's pretty simple, right? Well, if you inverse it to the earnings to price ratio, that's called the earnings yield. I know this is complicated to some extent, but you must understand this. In the case of a price earnings ratio of 18, or a price that's 18 times the earnings, you now have an earnings yield of around 5%. And all I did there is divide 1 by 18. As of July 2010, these same companies in the S&P 500 also had an average dividend yield of around 2%. So you can theoretically expect a return of 7%, which is that 5% earnings yield plus the dividend. So if you're thinking as you listen to this that you can go out and either expect personally or expect your mutual fund manager to do much better than 7%, think again. With all the drag that's encountered between taxation and transaction costs, it's tough enough to keep up with the market in real terms. Beating it is quite another, especially with changes that might come through in capital gains tax laws. If you're currently in the 25% federal income tax bracket, which isn't the highest, you have to earn around 10% just to show a net return of the 7% that the market should return. Okay, so bonds yield less than 5%. Stocks are expected to yield somewhat more, but not too terribly much. What about other asset classes? There are 3 more that I want to cover in this session: commodities, what's called day trading, and real estate. The reason is that these 3 get so much press today that millions of people are jumping into them and expecting to get rich quick. Now, let me say this. If we do encounter a long and high inflation, these 3 specific asset classes may in fact do quite well in opposition to traditional bonds and stocks. But let's put historical perspective on each. First, even though gold, which is considered a commodity, may be a good place to generate excess returns in 2010, ultimately gold is priced with inflation. It's not truly designed to be a money maker, but it is a money preserver. Now, there are professional traders who earn a very good living trading in gold, but we recommend to our members that you buy gold not as a tool to generate growth, but as a hedge to sustain buying power even in the face of large inflation. The second is day trading. Okay, I've been in this business a long time, so I kind of like this stuff. But in a period when the markets have unusually high levels of volatility, trading strategies work quite well. This notion of work quite well, by the way, presumes that you have some method to determine the direction of the volatility prior to it actually occurring. There are numerous companies out there that make millions of dollars teaching people how to day trade volatility. Now, I'll be honest with you and share my honest gut level opinion. First, I do think it can work, but only on small amounts of money. And I mean small. Some of these models they use only work on less than a couple of $1 million. These strategies rely on trading futures contracts, which may or may not have the liquidity to trade high volumes. Secondly, the person employing these strategies must be enormously disciplined and have a mental toughness that allows them to take each trade as its own entity and not mentally link trades. In other words, just because you made money or lost money on the last trade doesn't mean you'll be predisposed to do the same on the next. This sounds easy, but I'll tell you there are countless numbers of people who've lost bunches of money who thought it was easy. Remember, as you consider this method of investing, that in general, the markets are very efficient. That means that if there is a way to make extraordinary returns on some trading system, others will find it too, and then those returns will be arbitraged away. Let me give you a specific example. As part of the growing quantification of Wall Street, my initial firm, Chicago Investment Analytics, built models that forecasted relative price behavior. I'm very pleased to say that they worked. Our research team was truly unique in its ability to find excess returns. However, as the world of Wall Street became more and more computerized, more and more managers pumped millions and millions of dollars into building computers that could effectively reverse engineer our models. Thus, by the early 2000s, so many managers were following the same optimized computer models that they'd become almost self-fulfilling. By the summer of 2007, simply too many people were using the same models, and in the month of August of that year, almost all of the quantitative managers got hurt because their signals all said sell or buy at the same time. My point is that with any system, if it's truly good, others will find it. So on these day trading systems, keep in mind they're only for small amounts of money, and you have to be very, very disciplined. And in terms of future expectations for return, now this is much more difficult because returns for these things are all over the map. In my opinion, if you make a 30% annual return on your capital, you're doing better than all the experts on Wall Street. So I'm not sure I believe the numbers that I hear from the seminar companies that sell trading systems. But I think if you are successful, and I mean very successful, 30% is near the top of realistic returns. Regarding real estate, the final asset class I'll discuss, like anything, real estate is subject to bubbles, as we've just seen. When too much money flows into anything, prices run up unreasonably. Two types of real estate that might be attractive today would be farmland, this should keep up with inflation, and rentals. Now here's a quick valuation measure for you. It's known as the cap rate, and it's a pretty good measure of your estimated return. Let's say you have a $1 million property, and that nets an income of $100,000 per year in rents, and then you subtract out expenses. That's called a 10% cap rate. Now, your return, of course, is contingent on how much you pay for the building. If you pay cash for that $1 million building and then earn $100,000, you make a 10% return on your money. If you go out and secure a mortgage, though, to buy the property, you're going to earn a lower return, but as a return on your capital, that number will go up. Here's how. The $1 million property earning $100,000 or 10%. Let's look at that. Let's assume you put down $500,000 in cash and borrow the remaining $500,000 at 8%. Okay, on the $500,000 you paid cash for, you're going to earn 10% or $50,000. On the $500,000 you borrowed to buy the building, you're going to earn 2%, which is your 10% cap rate minus the 8% interest rate, or $10,000. So in total, you earn $60,000, which is a 6% return on the $1 million building, but a 12% return on the $500,000 of your capital. When you add in the tax deductions attached to real estate, this can be a very viable return. But bear in mind that you do bear the risk of principal loss. If that building you purchase becomes worth less than the $1 million, you eat it. So that's a session we have on estimating and expecting future returns. I'm sorry these returns may not be as high as many of you would have liked, but at least they're honest. Now, I could go on all day about valuations, and in future sessions we'll provide more metrics on how to value things. But for this session, you have the required piece of information.
As you think about asset classes, Steve has just provided powerful information you probably haven't heard before. After the recent shocks of the economic downturn, you are now better prepared to value your own assets appropriately.